major central banks this week are deciding on appropriate monetary interventions as they meet. The Bank of Japan announced that it maintained the short-term interest rate target in the range of 0.4% to 0.5% as expected, after concluding its two-day monetary policy review meeting. The statement stated that Japan's economy is showing moderate recovery, albeit with some weak signs, with both consumption and inflation expectations also moderately increasing. The governor's statement cautioned on the need for vigilance on impact of financial and foreign exchange market moves on Japan's economy, adding that he expects underlying inflation to move closer towards the price target in the latter half of the three-year period projected under the quarterly outlook report. The statement also highlighted risks, including impact of trade policies on global economies and inflation. The US Federal Open Market Committee decides later today, while the Bank of England and South Africa Reserve Bank will decide tomorrow. Almost all the apex banks are facing new pressures to reconsider and await clarity on the potential stickiness of inflation driven by the global trade turmoil and uncertainty, and could be more drawn to a wait-and-see mode. Hello, welcome to Global Business Insights, where we analyze the main business stories. We look first at the South Africa Reserve Bank monetary policy decision to be taken tomorrow after deliberations at the already ongoing three-day meeting. Analysts are somewhat divided on whether the South Africa Central Bank will be held back in further easing by the rising global and domestic risks and hold rates steady at 7.5%. Inflation rate rose for the third month to 3.2% in January 2025, the highest in 4 months, but well below the South African Reserve Bank's preferred midpoint target of 4.5%. Yesterday, we also reported a survey showing average inflation forecast in 2025 was lower to 4.3% from 4.5% in the previous survey. Based on direction of headline inflation, many expect the South Africa Reserve Bank will probably hold rates, or the MPC could cut the repo rate by another 25 basis points. Analysts also will understand the wait-and-see stance given the highly elevated levels of uncertainty both globally and domestically. Just in this morning, we got the February inflation data. Annual consumer price inflation South Africa was 3.2% in February 2025, unchanged from January 2025. Month on month, CPI increased by 0.9% in February. Goods CPI 2.5%, up from 2.4% in January 2025, while services was 3.8%, down from 4% in January 2025. The latest ABSA Purchasing Managers Index for South Africa dropped to 44.7 in February 2025 from 45.3 in January, also the fourth consecutive contraction in factory activity and the sharpest decline since August 2024. The economy grew by a very tepid 0.6% in 2024, also the slowest growth since 2020. A 25 basis points easing to 7.25% would be a very welcome monetary boost, so the chances are looking like 50-50. For the Bank of England, it looks like a largely uneventful Thursday decision, with markets already pricing in a 95% chance of a hold the session. With the US FOMC, markets expect also a hold the session, but the dot plot and updated summary of economic projections (SEP) may unveil a surprise or two. Will we see fresh concerns with inflation and the surge in longer-run inflation expectations leading to scaling back rate cut forecasts? Or would the FOMC be driven by signals pointing to a weaker economy, prodding them to predict more rate decreases, which will again boost the stock market? I tend to lean more towards a hawkish slant coming from the FOMC, with the usual statements warning that they will remain closely data dependent. Talking of data, the latest personal consumption expenditure index metric, which is the FOMC preferred inflation metric, increased 2.5% year on year in January 2025, marking its first slowdown in 4 months compared to 2.6% in December 2024, and in line with expectations. But again, this is a lagging indicator, as we know. On the data projections, the Fed could raise its 2025 outlook for inflation. In December, the outlook was for 2.5%, that's the PCE, in both core and headline, and lower its GDP projection from 2.1%. The committee could maintain its December outlook for 2 cuts in 2025, that's in the dot plot, or remove one. That could be a hawkish slant, but analysts think everything seems to be on the table. Some more business stories. After the call between Trump and Putin, Russia and Ukraine have agreed to refrain from attacking each other's energy infrastructure for 30 days. Call it baby steps towards a truce, as Putin immediately issued an order to that effect to the Russian military after the call. European natural gas prices slipped as warming weather forecasts and the planned talks between US President Donald Trump and Vladimir Putin appeared to boost prospects for the region's gas supply balance. Policy uncertainty is still at the root of a pullback in US equities. The stock market couldn't string together a third daily gain in a row. The yield on the 2-year Treasury note also fell to 4.04%, while the 10-year yield was down to 4.28%. Last Thursday, the S&P 500 entered correction territory, but it rallied with the other 2 major indexes on Friday and Monday. All 3 indexes are lower at close yesterday. And on data, US industrial production expanded by 0.7% on a monthly basis in February, after the 0.3% increase recorded in January, and better than the market expectation for growth of 0.2%. Manufacturing output rose 0.9%, boosted by a jump of 8.5% in the index for motor vehicles and parts, while capacity utilization stepped up to 78.2%, a rate that is still 1.4 percentage points below its long-run average, that's 1972 to 2024 average. And in the UK, The Independent is launching a new service using Google AI tools to provide summaries of its articles overseen by its journalists. The London-based media group will launch the platform later this month. And more on AI, NVIDIA announced new chips for building and deploying artificial intelligence models at its annual GTC conference yesterday. CEO Jensen Huang revealed Blackwell Ultra, a family of chips shipping in the second half of this year, and Vera Rubin, the company's next generation graphics processing unit, or GPU, that is expected to ship in 2026. Blackwell Ultra chips will be able to generate far more content in the same amount of time as its predecessor, allowing cloud providers to offer a premium AI service for time-sensitive applications, and so helping them earn as much as 50 times the revenue when compared to the Hopper generation of chips which shipped in 2023. Cybersecurity startup Wiz has agreed a termination fee of about 10% of its $32 billion acquisition by Google parent company Alphabet, highlighting the significant antitrust risks the deal could face. Yesterday, we reported Alphabet had agreed to buy Wiz, its largest acquisition, reviving a deal that fell apart last summer. There is a sense that the present US administration is more friendly to markets and business, and perhaps this means a lower chance of scuttling the transaction. Germany's Bundestag voted in favor of a major fiscal package, which includes changes to long-standing debt policies to enable higher defense spending and a €500 billion infrastructure and climate fund. The law now needs to be approved by the Bundesrat, a body representing the country's states, on Friday to become enshrined. German industrial giant Siemens yesterday said they were cutting 2% of its global workforce, that is over 6,000 jobs worldwide, due to weak demand and increasing competition in China and in its home market. The cuts are mainly from factory automation unit and some positions in its electric vehicle charging business. Audi is reviewing its plan to stop introducing new petrol models from next year as a delayed transition to electric vehicles pushes the premium car maker to cut 7,500 jobs, 14% of its German workforce. It said it was no longer certain it would meet a previous target of launching its final new combustion engine car in 2026 and ending sales of such vehicles outside of China entirely by 2032. Morgan Stanley plans to cut about 2,000 jobs later this month. The job cuts, the first major workforce reduction under CEO Ted Pick, will take place across the firm, but will not affect the roughly 15,000 financial advisors of the bank. So it's more the non-core support roles that will be affected. Social media site X's valuation has soared back to about $44 billion, underscoring the sharp turnaround in the company's fortunes. Investors valued the platform at $44 billion in a secondary deal earlier this month. X was also working on raising fresh capital in a primary round, which would aim to raise about $2 billion through selling new equity, and that could be used to pay off more than $1 billion of junior debt that Musk agreed to take on to finance his buyout of a company then known as Twitter in 2022. The Trans-Niger pipeline, one of Nigeria's biggest pipelines carrying crude from the Niger Delta to the Bonny terminal, was rocked by a powerful explosion on Monday night. The explosion at Bodo-Gokana local government area of Rivers State caused a massive fire with no clarity on the causes. Militants had earlier threatened to attack oil infrastructure in the Rivers State amid an ongoing political crisis between the state and the federal government over federal money allocation to rivers. As the politically driven tension goes on, it definitely would affect the production levels and export potential, as well as investment appetite, raising the risk premium and also raising security costs, further making these oil blocks in this region less attractive. Yesterday, a Nigerian judge dismissed state oil company NNPC Limited's objection to its inclusion in a lawsuit brought by Dangote Oil Refinery seeking to stop imports of gasoline into the West African nation. The lawsuit argues that the sector regulator, Nigerian Midstream and Downstream Petroleum Regulatory Agency, MPDPRA, is violating the law by continuing to issue gasoline import permits to NNPC and other fuel traders, adding that the law allows only imports in order to address production shortfalls. Dangote is seeking 100 billion naira, that's $65 million, in damages from NMDPRA, from NNPC, and 5 smaller fuel marketers. Oil prices fell after Russia agreed to Trump's proposal that Moscow and Kiev stop attacking each other's energy infrastructure in a 30-day ceasefire, implying more Russian oil supply entering global markets. Brent was down 0.34% at just over $70 a barrel in early morning trade. Asia-Pacific markets were mostly subdued, while the yen steadied after the Bank of Japan held rates as was expected. The euro remained close to the 5-month high it reached yesterday after Germany's parliament approved for a significant increase in spending, handing the Chancellor-in-waiting Friedrich Merz a huge boost. Well, that's all we can take in this episode of Global Business Insights. Thanks for watching. This is Bode Oshosani. Bye-bye.